All right, so I put together some more practice multiple choice questions, and these relate to Chapter 7. There are 10 of these. And so what I'll do is I'll read the question, and then I'll pause for a minute, and then I'll go through the correct answer. And you should know that the files related to these are under practice problems as well. There's Chapter 7 practice multiple choice questions, and then the key to these is also there in your files. Okay, so here we go. So number 1, which of the following statements best describes the priority of the tax treatment of a distribution from a corporation to a shareholder? And then you have 4 options. All right, so I'll pause for a little bit and let you read your options, and then I'll discuss the correct option. All right, so remember that when the corporation makes a distribution, the distribution is a dividend to the extent of earnings and profits. And it can be either current earnings and profits or accumulated earnings and profits. Then it's a return of capital. And then lastly, it could be treated like a gain from a sale of stock. Okay, so your correct answer is A. And that is just a result of the statutory requirements from the Internal Revenue Code, and that'd be Section 301C if you wanted to look it up. Okay? So that was question number 1. Here is question number 2. Which of the following statements best describes the role of current and accumulated earnings and profits in determining if a distribution is a dividend? And I'll pause for a little bit and let y'all read your options. All right, so remember, distributions are first treated as if paid out of current earnings and profits. So first, assume distribution is paid out of current E&P. All right. So what does that mean? That means at a minimum, some portion of a distribution will be treated like a dividend if current earnings and profits are positive. Okay. So that's number 2. All right. So let's roll on to number 3. And I got to switch pages for that. There we are. All right. I'm going to resize. Okay. All right, so number 3, which of these items is not an adjustment to taxable income or net loss to compute current earnings and profits? All right, so which of these items is not an adjustment for earnings and profits? All right, so this is kind of a difference between the cash and accrual method of accounting. So remember that refunds of prior year taxes are only included in current E&P under the cash method. And I'll write that down. Okay, so only under the cash method. So then in this situation, your correct answer, which one of these things is not an adjustment to taxable income or net loss to compute current E&P, is option D. Okay. All right, so let's go on to number 4. All right, and number 4 is computational. So let's take a look at number 4. Packard Corporation reported taxable income of $1 million in year 3 and paid federal income taxes of $340,000. Included in the taxable income computation was a dividends received deduction of $5,000, a net capital loss carryover from year 2 of $10,000, and that was utilized in year 3, and a gain of $50,000 recognized on the collection of cash from an installment sale that took place in year 1. The corporation's current earnings and profits for year 3 would be, and so let's pause now. All right, so this question requires us to actually compute current E&P for year 2003. All right, so let's start with what we know. All right, so we've got taxable income. All right, and what are we going to have to do? Well, we're going to have to subtract out the federal income taxes paid. And that was $340,000. Okay. Now, what was included in the taxable income? There was a dividends received deduction. All right, so we need to add that back. Okay. There was also a net capital loss carryover. Okay. So we get to add that back. So that was $10,000. All right. And a gain of $50,000 recognized on the collection of cash from an installment sale, okay, that took place in in year 1, okay? So that has to be subtracted out, okay? And so what do we end up with? We end up with $625,000. So your answer is D. Okay? And looks like I need to go to the next slide. All right, so here comes number 5. Madison Corporation reported taxable income of $400,000 in year 3 and accrued federal income taxes of $136,000. Included in the computation of taxable income was regular depreciation of $200,000. Earnings and profits depreciation was $60,000. And a net capital loss carryover of $20,000 from year 2 utilized in year 3. Again, we're looking at the corporation's current earnings and profits for year 3. So I'll pause for a moment and let you guys take a look. All right, so let's start putting things together. All right, so what are we going to start with? Again, we're going to start with our taxable income. So that was $400,000. We have federal income taxes of $136,000. All right, so now we've got this depreciation issue. All right, what do we have to do? Well, we've got regular depreciation and earnings and profits depreciation. Earnings and profits depreciation is what we're concerned with. And so what we need is the difference, right? But we can do that a really smart way, and it's less confusing. So if we add back our regular depreciation and then recognize our earnings and profits depreciation, so this is regular depreciation, and this is E&P depreciation, okay? And then we also know we had a capital loss carryover, so we get to add that back. And was there anything else? Nope, there wasn't anything else. So we've got all those. We need to total those up, and those total up to be 424,000. And so A is our answer. All right, so now we can move on to number 6. All right, so now we've got the Bruin Company, and it's another computational question, sort of, okay? And so the Bruin Company reports earnings and profits of $200,000 in year 3 and accumulated earnings and profits at the beginning of the year of $100,000. Bruin distributed $400,000 to its sole shareholder on January 1st of year 3. How much of the distribution is treated as a dividend in year 3? Okay, so I'll pause a minute and let you guys think. All right, so remember that first we have to look at current E&P, okay? And we've got $200,000. And then we look at accumulated E&P, and that was $100,000. So what is our total E&P? Well, our total E&P is $300,000. And what do we know? We know that that distribution, the part of it that is equal to our E&P, can be treated as a dividend. So that means that 300,000 would be treated as a dividend. Okay. And now, I've got to go to the next slide. And that brings us to 7 and 8. I'm going to make these a little bigger so everybody can read them. All right, so let's look at number 7. So number 7 says, Beaver Company reports earnings and profits of $100,000 in year 3 and accumulated earnings and profits at the beginning of the year of $200,000. They distribute $400,000 to its sole shareholder at the beginning of the year. The shareholder's tax basis in her stock is $200,000. How is the distribution treated by the shareholder in 2003? All right, so take a look. I'll pause for a minute. All right, so what do we know? Well, again, let's look at our earnings and profits situation. So let's look at current, E&P, and accumulated E&P. So our current E&P was 100,000. Our accumulated E&P at the beginning of the year is 200,000. So our total E&P was 300,000. Okay. So we know that 300,000 is a dividend, okay? But they distributed 400,000. So the question is, how is that other 100,000? So 300,000 is a dividend. That other 100,000 is what? Well, your first option is for it to be a tax-free return of basis, assuming that there is enough basis in the stock. And so we've got this $100,000, so we need to compare it to a shareholder's basis in stock. All right, and the shareholder's basis in their stock is 200,000, so they have enough basis to absorb that extra $100,000. So what you end up with is a $300,000 dividend, and then that other 100,000 is a tax-free return of basis. Okay? If they didn't have enough basis, what would that $100,000 be? Well, if they didn't have enough basis, then the next option is for that $100,000 to be treated like a capital gain. All right? Okay? Now let's move on to number 8. All right, in number 8, we have the Tar Heel Corporation, and they have current and accumulated earnings and profits of $500,000 at the end of year 3. On December 31st, the company makes a distribution of land to its sole shareholder. The land's fair market value was $100,000, and its tax and E&P basis to Tar Heel was $25,000. William assumed a mortgage attached to the land of $10,000. What are the tax consequences of this distribution? All right, so I'll pause for a minute and let you guys ponder. All right, so this is really kind of a statutory question, because what do we have? All right, we've got a corporation with earnings and profits of $500,000, and they're distributing property. Okay, the fair market value of that property is less than the amount of earnings and profits, so we don't have issues there. We have a tax and earnings and profits basis, all right, to the corporation. And then we have this mortgage, all right. Well, what we're concerned about immediately is, what are the tax consequences of this distribution to William? Okay, so first question. Is there enough earnings and profits for this to be a dividend? All right. And we've got 500,000 of earnings and profits, and we've got a fair market value of $100,000. So the answer is yes. All right. The second then is, what is the amount of the dividend? All right. And the answer to what is the amount of the dividend is going to be, what is the value of the property that was distributed? All right, so essentially, what is the value of the property that was distributed? But asked a different way, and I'm going to scroll up just a little bit. What is the economic benefit to William? All right, so what's the economic benefit to William? Well, what did William get? He got $100,000 of land, all right, because we're concerned with fair market value, but he assumed a $10,000 mortgage. So what's the net value of those? The net value is $90,000. Okay, so based on that, we know he gets a dividend of $90,000, so we can narrow down to either C or D. Okay, then we have to figure out what is his tax basis in the land. Well, his tax basis in the land is the fair market value at the time of the distribution. So that means his tax basis in the land is $100,000. So then we can come back up here and look at C and D, and we see that C has a dividend of $90,000 and a tax basis in the land of $100,000. All right. So now we roll on to the last two problems. We've got numbers 9 and 10. All right, so here we are. Number 9 is purely conceptual. So which of the following are subtractions from taxable income in computing current earnings and profits? And then you have some choices. Federal income taxes paid. Well, we did that in every current problem that we computed. So let's put a little check mark by that one. Current charitable contributions in excess of the 10% limitation. All right, is that going to be a subtraction from taxable income in computing current earnings and profits? Yeah, it sure is, right? Current year net capital loss. That is also going to be a subtraction from taxable income. All right, so your answer for this one is D. All of the choices are subtractions from taxable income in computing current earnings and profits. All right, and then lastly, number 10, which of the following statements is not considered a timing difference due to separate accounting methods for taxable income and earnings and profits? All right, so take a look. And so the key is which is not considered. All right, and so the answer here is the dividends received deduction. Okay, it is not considered a timing difference for taxable income and earnings and profits. All right, that is it for these 10 problems. Again, you can find these multiple choice questions and a key for these multiple choice questions in 2 different documents in the files section of our Canvas page. Thanks, y'all.